Okay, so let's start with receivables management now. We had done a few areas from chapter number 9, and now we're going to start receivables management. Remember, we said working capital means current asset minus current liabilities. So the current asset need to be financed. Current asset need to be financed, like for example, receivables or inventory, or for example, cash, right? This need to be financed, right? We'll need money. We'll need to take, let's say, overdraft to finance them, right? Now, how do you finance it, or how do you manage all of them? So we're going to do it separately. So the payables, we'll do it separately. Receivables, inventory, and cash management we'll do separately. And we'll start from receivables management, right? Payables is not very common in the exam, but yes, sometimes it is also tested in exam. So remember, payables is the opposite of receivables, right? It's not very common. We'll just do one question on payable, but it's just the opposite of receivables, right? Receivables, should we have more receivables or less receivable, right? Again, the answer is it should be in a balance, right? Receivables, is it good? Well, receivables are good because, of course, you encourage your customers to buy more from you, right? You encourage your customers to buy more from you, so you offer them credit, right? So it encourages your sales. So that means that if receivables are increasing, your sales will be increasing, your profits will be increasing. But on the other hand, if receivables are too high, then that would mean you'll have the risk of number one, bad debt. Right? Some of the customers will never pay you back. Some of the customers will pay you late, right? You'll be short of cash. And for that, you will need to take money. So you see, receivables, so it's the time period when you get the money from your customers, right? So when you sell them and then you get the money from your customers, right? So in other words, we can simply say that you sold it at this point and then you get your money at this point. That's what we call the receivable days. So let's say it's 60 days, right? If it is 60 days, then it means for 60 days, if you don't have the money, you need to take, let's say, a short-term finance, let's say overdraft for that, right? So let's say your total overdraft that you have taken is $1,000. 500 out of this 1,000 you have used to finance receivable. And let's say 500 you have taken the overdraft to finance inventory, right? And this overdraft has an interest rate of 10%, right? This overdraft has an interest rate of 10%. So to finance receivable, you have taken $500, and to finance inventory, you have taken $500. Overall, you have taken $1,000, and the rate is 10%. The interest rate is 10%, right? So what will be the cost of financing? Cost of financing receivables, or in simple words, we can say interest cost. Cost of financing receivable. Well, 500 is the finance for which they have to pay 10% interest. So how much will be the cost of financing? $50, isn't it? That's what we call the cost of financing receivables, right? Now, is it clear, everyone? Yep. Is there any issue? Please stop me if you face any issue. right? So that's the finance cost, $50, but this is the finance cost relevant to the receivables only, right? Similarly, we can take the finance to receive I mean the cost of financing inventory, and let's say that will be again 500 multiplied by 10%, so that will be $50, right? So we multiply the receivables multiply by the 50 the interest rate, right? Now, how much are you going to finance for the receivables? Well, that should be equal to the amount of receivables, right? That should be equal to the amount of receivables. So that would mean that when we say cost of financing receivables, you actually multiply receivables multiply by the overdraft interest rate, right? That's the formula for financing the receivable. Receivables multiplied by the overdraft interest rate, because equal to the amount of receivables, you'll be taking the overdraft for receivables, right? That's how much you're going to take uh, the short-term loan, right? The short-term finance, right? Receivables. So now, do you think is there any way to save this cost? I mean, this cost right now, in this example, it is $50. Is there any way to save this cost or to reduce this cost? How can we save this cost? What do you think? Yes, one way of reducing this will be to take overdraft or look for the overdraft which has cheaper interest rate. What is the other way of reducing this cost? Yes, you try to sell less on credit. You try to sell less on credit, or you try to receive early from your customers, right? So what you can do is, maybe that's not in our hand to choose an overdraft with a smaller interest rate, because maybe that's not something that we can affect that much or influence that much. But what we can do is, we can try to receive early from our customers to save cost of finance. We can, number one, stop credit sales, right? You just sell on credit on cash, but sometimes it's not going to be a very good option because you want to sell and survive in the market also, right? Or try to receive early from customers. In other words, we are saying reduce receivable days. If you reduce receivable days, automatically receivables will be reduced as well, right? So you try to receive early from your customers, right? How can you receive early from your customer? One of you have already mentioned this. How can you encourage your customer to pay you quickly, right? Or early? You offer them early payment discount. What else can you do? You can take the facility of factoring. Factoring can actually reduce your receivable days as well. I mean, they can actually uh, force their customers to pay at least on time if they cannot pay early. So they can actually force them to pay on time, right? What else can we do? You can also have good credit control department, right? Like when the amount is due, they'll start calling everyone, look guys, you have to pay us money, right? Today is, let's say 15th, you're supposed to pay on 15th and you haven't paid yet, right? So of course, it will encourage the customers at least to pay on time and not delay it, right? Remember, receivable days is not the period on which you have agreed. Like, let's say, for example, if we have agreed with the customer that the customers are supposed to pay in 60 days, that's not receivable days. The receivable days will be the actual time period. So let's say, for example, you agreed with the customer to pay in 60 days, but actually, on average, customers takes 70 days, right? So that will be your receivable days. That's the time period you have allowed the credit for. But maybe the customers, well, the customers are never going to be paying every time on time. Sometimes they're going to delay the payment. So that's the receivable days, right? So you can at least, your good credit control department can force them to pay on time, right? Yes, you can do the credit check of the customer. You only give credit to those customers who are worthy of worthy of paying you back on time, right? So yes, there are different ways to reduce um, your receivable days, and this will actually gives you savings of the finance cost. But there are pros and cons for everything. You see, like if you offer them early payment discount, of course, the customers will pay you early. Watch it very carefully. If you offer them early payment discount, the customer will pay you early, right? You will take less, you'll have less receivables, you'll take less overdraft, and you'll have less interest cost as well. But when you offer them discount, you have to bear the discount cost. Of course, that will be a cost for you as well, right? So should we offer early payment discount or not? Well, we have to see that how much we are spending on the discount cost and how much we are saving in the interest cost, right? So you have to actually measure and then you have to decide if it is a good option or not. Similarly, factoring, right? Well, factoring will reduce your receivable days, but the issue is this can upset some of your customers, right? If the credit control department is very strict, again, this can upset some of your customers. And the other thing is, if you are taking the factoring facility, you have to give something to the factor also. That's also a cost in the form of interest if the factor is financing you, or let's say if the factor is giving you the debt collection service, then you have to pay something again for that service. If the factor is giving you the credit insurance, you have to pay something for that as well, right? So, of course, you cannot simply say if it is a good option or a bad option unless you measure it. So that's how you will be tested in exam as well. So if you see on the next page, we have a small area, which is again frequently tested in exam, right? Credit management. What is included in the credit management? First of all, in credit management, you want to see or you want to assess the credit status of your customer, right? Credit is not something that you have to definitely give to all the customers. Of course, you'll see if the customer is a good customer, you offer them credit. If you think the customers will be paying you on time, you offer them credit, right? And if you think the customers is not going to pay you on time, you don't offer the credit, right? So assessing the credit status, there are three areas to be covered in credit management: assessing the credit status, and then you have to see what should be the terms of the credit. And credit management also include the day-to-day management, right? So assessing the credit status, first of all, number one, right? Assessing the credit status, you want to see the credit worthiness of all the customer, right? Especially your new customer, right? You want to see if the customer is worthy of taking credit or not. Now, how do you do it, right? You can do bank references, right? You can see their, let's say if it is, for example, a company, then you can see their financial statements as well. Or if it is a business, you can see their financial statements. You can do trade references, like you can ask other people, let's say, for example, if they are buying, let's say, from someone else, right? So maybe you can contact them and ask them if they are good customers or not, if they were already in relationship with someone else, right? Well, the issue here is that if they are your competitor, maybe they are not going to give you the information, but maybe you can get the information from someone else, or let's say, for example, from another company within the group, if they're taking from or purchasing some from someone within the group of the businesses, right? So the bank references, the trade references, and of course the published accounts, right? Your financial statement, as we said, right? The bank statements and the financial statements, right? If it is an existing customer, then you can see your own sale records for existing customers. You can see your own sale records, and you can see if the customer has paid you on time or not before. But the more modern technique is the credit rating agencies, right? Now, these are agencies who gives you this service to assess the credit worthiness of your customer. You see, like there are different ways of assessing a customer. Let's say, for example, let's say this is your business and you sell laptops, right? This is your business and you sell laptops, right? A customer visits, right, and ask for the laptop. Now, the deal on the laptop is buy now and pay after 3 months. Buy now and pay after 3 months. Are you going to give this credit to everyone? Maybe not everyone. So what happens? This customer, when is going to visit your, let's say, shop, right? So you ask for his debit card or credit card, and let's say you put that in the debit card machine, right? You put it in, and now you will be automatically linked with the credit rating agencies, right? And the credit rating agencies, by looking at the debit card, they're going to get some information and give you the information. And let's say they're going to tell you that how good is that customer. He's going to give you a rating for a particular customer, right? So for example, a good customer will get good rating, right? Now the credit rating agencies are going to have access to a lot of information about this customer when it is connected through his debit card, for example, right? Like what's the address, right? Where exactly is that customer living, right? Is he living in a posh area, right? Or not, right? Is he working somewhere? Is he getting regularly his salaries in his account, right? Is that customer paying his bills on time every time or not, right? So in this way, the customers, the information about the customer, the credit rating agencies will give us some information about the customer, if it is a good customer or not a good customer. So let's say the credit rating agencies doesn't give very good rating to this customer. So maybe you tell this customer, okay, I cannot actually give you this deal, right? But there is another deal. You can actually buy now and pay next week. And let's say if there is another customer and he even has credit rating even worse than this, maybe you can say that, well, you can buy it on cash but not on credit, right? So credit rating agencies, right? Is it clear? Assessing the credit status. Is it clear to everyone? After the credit rating agency, what should be the terms of the credit? As we said here, for example, the terms of the credit, we said buy now, pay after 3 months, right? So what should be the amount? Let's say, for example, the credit they are currently offering is $500, right? For 3 months, right? So what should be the value of your credit? Should it be $500, $400, $100? Should be more than this. How many number of days of credit you should offer to your customer, right? Should you offer any early payment discount if the customer choose to pay you early rather than 3 months? If the customer pay you, let's say within 1 month, do you offer any discount, early payment? Or do you charge the customer if the customer doesn't pay? Yeah, sorry about that. Can you all hear me now? Yep. Okay, so we were discussing the discount, or for example, if the customer doesn't pay you on time, then do you charge anything extra? Is there any interest on overdue account or not? Right? So that's the terms, right? In the credit management, that's also is considered. And then you have the day-to-day management. I mean, there are no rules for the day-to-day management. Well, let's say for example after 30 days you send a statement of account, right? Let's say you are not paid on time, so after 7 days you send a reminding letter, still not paid. After 7 days you send a second reminder, still not paid. You actually, let's say for example after 7 more days you take or give a threat of taking legal action if the customer is not paying you on time. Or let's say for example after 7 days, if it is still not paid, maybe you would like to go for the legal action, right? If the customer is not paying on time, right? Or maybe you will not do anything, because you see taking legal action will be a big cost as well, right? So you don't want to, you have to assess everything, right? So day-to-day management, terms, and assessing the credit status. Now, as we said before, the cost of financing receivable, it's actually the interest cost that we were talking about. So interest cost to finance receivables, right? And what was the formula? The formula was your interest cost is equal to receivable balance multiplied by the interest rate, right? Your receivable balance multiplied by the interest rate, right? Typing error, you can correct that, right? Okay, now if you have to find out the receivable balance, how do you find it, right? What was the formula for receivable days? That was receivables divided by sales into 365. So what will be the formula for receivable balance? I mean, you have to rearrange it. Receivable balance is here, receivables, right? So your receivables, the sale is going to go to the other side of the equation, so it will become receivable days into sales divided by 365. That's how you find out your receivable balance, right? REC is the receivable balance, right? So you have to rearrange it. Let's say, for example, if you have to find the receivable balance in the exam, and we're going to do it now, or the formula is actually given to us on the next page, right? Receivable balance will be sales into receivable days divided by 365, right? It wasn't difficult. Let's see a question so that it makes more sense, right? I have copied this question from somewhere, but it's a good question for learning. Shankly Limited has sales of 40 million for the previous year. Receivables at the end were 8 million, right? Receivables are 8 million. The cost of financing debtors, or the cost of financing receivables, is covered by an overdraft at an interest rate of 14%. So this is the overdraft interest rate. What do we need to find? What is receivable days for Shankly, right? You guys are going to do it, right? I'm just telling you, receivable days is something that you want to find, right? You're given sales and you're given the receivable balance. So how do you find the receivable days, right? Let's see who can do it before me, right? Someone has already done it. Question 9.2, part A. Part A was receivable days. Receivable days. And that's receivables, which is 8 million, divided by sales. We're assuming that that's all credit sales, into 365. So receivable days, 73 days. Thank you very much. So that means currently our customers are paying us in 73 days. 73 days to pay us, right? Okay. And the second one, good job. Someone has done the second one as well. The second was part B. Calculate the cost of financing. Cost of financing receivables, which means your interest cost, right? That will be receivables multiplied by interest rate. Receivables is given to us in the question, it's 8 million. Interest rate is 14%. So the cost of financing receivable will be $1.12 million, right? Nothing difficult about it, right? Good job, everyone. Good job, right? So that was question 9.2. Let's see what do we have now. Now remember, if we want to save this cost, how can we do it, right? Watch it very carefully. Watch it very carefully. If you want to save this cost, what do? You reduce your receivable days. Once you reduce your receivable days, your receivable balance will be automatically reduced. And that's why, and that would mean your interest cost will be reduced as well, right? So let's write something to save interest cost. We can reduce our receivable days, which will reduce receivable balance. Therefore, will reduce interest cost, right? So you reduce your receivable days, right? To save interest costs, we can reduce our receivable days. When you reduce your receivable days, your receivable balance will be reduced as well. When the receivable balance is reduced, of course, if we have a smaller figure in here, we're going to get a smaller interest cost as well. So that would mean interest cost will be reduced as well, right? So that's what we are going to do. And you guys actually suggested me that, well, if you want to reduce your receivable days, there are different ways of reducing it. Like you should have like tight, you should stop credit sales, or you should offer early payment discount or factoring, or you should have like a tight credit control department, right? So there are different things that we can do. So we'll start with the first one, which is the early payment discount, right? Now, early payment discount, there are other words for early payment discount also. Can you tell me what are the words? Early payment discount. What are the other words that are used? Anyone? Yes, so you're right. It can be called the prompt payment discount or the settlement discount. Prompt payment discount, settlement discount, or cash discount, right? That all means early payment discount, right? Please don't mix it with bulk purchase discount. It has nothing to do with early payment. Bulk purchase discount, you get it when you buy in bulk, not when you pay on time or you pay early, right? The trade discount is also different, right? The cash discount, when you get the discount because you want to pay early, because of paying early, the discount that you get, right? Now, 9.3, it says, Shankly as above, so all the figures are as above, but a 2% discount is offered for payment within 10 days. Remember, currently our customers are paying within 73 days, but if they pay in 10 days, they are going to get 2% discount, right? But remember something, we have not sold it to the customers yet. We will sell it to the customer, right? We are planning for it, right? We are planning for it. So we are really not sure who want or who will be taking the discount or who will not be taking the discount, right? We are selling it to the customer. We are telling our customers, look, you can pay us in 73 days. You can pay us in 73 days. But if you pay us in 10 days, we will give you 2% discount. Now we really don't know if the customers will actually pay us in 10 days or the customers will pay us in 73 days. So we have to guess that how many of the percentage of the customers are going to pay within 10 days and how much percentage of the customers are going to pay in 73 days, right? We're really not sure. And that's why the question is saying, should the company introduce the discount given that 50% of the customer will take up the discount? So that would mean that 50% of the customers will pay in 10 days and the other 50% of the customers will pay in 73 days, right? Right? That's what we are guessing for the future, right? So what should we do now, right? Should the company introduce the discount? What do you think? Should the company introduce the discount or not? Should the company introduce your discount or not, right? Okay, never give sweeping statements. I told you before as well. You have to do the measurement before. Yes, let's calculate it first, right? Because if you give sweeping statements, then people are going to call you what? People are going to call you what? A sweeper, right? And you are an accountant, you are not a sweeper, right? Okay, so question 9.3. Now what I'll do is I'll do actually comparison. Right? I want to see that how much will be our cost if discount is not offered, and then cost if discount is offered. Now, whichever cost is low, we're going to go for that option, right? If the discount, we want to consider our overall cost, right? So cost if discount is not offered, well, we have done this calculation over here. Our finance cost is 1.12 million, right? And we can do it again over here as well, right? So interest cost is receivables, which was 8 million multiplied by the interest rate 14%, and our overall cost was how much? 1.12 million, right? That's our overall cost, right? But how much will be our cost if the discount is offered? That's what we have to see now. Now, previously we had no discount cost, but now we'll have the discount cost as well. So first of all, let's calculate the discount cost. Right? Discount cost, right? It says that the discount is 2%. 2% of what? 2% of sales, which is 40 million. But do you think all the customers are going to take this offer? No. only 50% of the customers will take the discount. So our cost will be only for the 50% of the customers. So 2% of sales, but not all the sales, 50% of the sales, right? So how much is the discount cost? Discount cost, how much is the discount cost? 0.4 million, right? 0.4 million, right? Now, what about the interest cost? Well, interest cost will be reduced, of course, because our receivables will be reduced. But how much will be the receivables now? We have to calculate it actually, right? So that will be equal to receivables multiplied by the interest rate. We know that the interest rate is 14%, but how much is receivables? Receivables, we said, when you have to calculate it, that will be sales multiplied by receivable days divided by 365. That will be receivables. And this receivables need to be multiplied with the interest rate. Okay, who's going to tell me the receivable days now? How many are the receivable days? Come on, who's going to tell me the receivable days? Yes, that's the issue. I mean, we have two kinds of receivable days. We have customers who will be paying us within 10 days, and then we'll be having customers who will be paying us in 73 days. So what do? We actually calculate average receivable days, right? So I'm going to do a calculation here. Average receivable days, right? We know that 50% of the customers are going to pay us in 10 days, and 50% of the customers are going to pay us in 73 days. Remember, you always have to calculate weighted average, not the normal average. In this question, even if you calculate normal average, it will work, but not in all the questions, right? So this should give us 10 multiplied by 50%, which is 5, and 73 multiplied by 50%, which should be how much? 36.5. So how much will be receivable days? Average receivable days 41.5, right? So now we're going to write this 41.5 over here, right? So sales 40 million. Receivable days 41.5 divided by 365 will be your receivables, and you have to multiply it with 14%. Can you tell me what do you get in receivables first of all, right? 40 multiplied by 41.5 divided by 365, which will give you 4.547945. Can you see it clearly? Because the receivable days are reduced. Because the receivable days, the average receivable days before for this period was 73 days. Now the average receivable days are 41, and that's the reason. If you consider only the receivables, it was 8 million, and now it has reduced. Why? Why reduced? Why reduced? Because receivable days are reduced. That's why receivable balance will be reduced. And now this will be multiplied with 14%, right? Is it clear, guys? 0.14. So that will give you 0.637. 0.637. So previously, how much was your total cost? This much. How much is your cost now? The discount cost and the interest cost. Now, though the interest cost has reduced, but now because we have the discount cost as well. So how much will be the total cost? Your total cost will be your discount cost plus your interest cost. which is 1.037, right? So how much was our overall cost before? This much. How much is our overall cost now? This much. So should we offer discount or not? What do you think? I'll come to your question in a while, right? Apart from this question, is there any other question? Anyone who has any confusion, please do let me know, because that's how your exam question will be, right? So make sure you actually understand everything.
Can you explain me about the
So okay. So a couple of questions from you guys. First of all, you said, what about average receivable days, right? So average receivable days, you see, 73%, sorry, 50%, half of the customers or 50% of the customers said we will pay you in 10 days. It means that the remaining 50% of the customers will pay us in 73 days, right? This question is actually continuation of the last question, isn't it? Right? So previously, in the previous question, we said the receivable days was 73 days here, right? So we are assuming, you see, 73 days in part A of 9.2, right? So now we are assuming that half of the customer will pay us in 10 days, but the other half will still pay us in 73 days. So we have to calculate the average receivable days, average. The average will be somewhere in between 10 and 73. It will be in between 10 and 73, right? Right? So you calculate the average receivable days and then write it here, right? But one of you asked me that, can we actually simply say 10 plus 73 divided by 2, because the average means the midpoint? Well, it is actually the same answer for this question, but it won't work for every question. You know why? Because in this question, we said half of the customers are paying in 10 days and half of the customers are paying in 73 days. Let's say if your examiner say that 80% of the customers are going to take the discount and pay us in 10 days and 20% of the customers are going to pay us in 73 days, then you cannot use simply half, right? You have to calculate weighted average. It should be weighted average, not normal average, right? Yes, right? Okay, now, in today's class, remember something, what I'm going to do next, right? Maybe you're not going to like it, right? Because sometimes students don't like me for this because I go into too much detail, right? But trust me, it's actually very important for you guys, because your examiner does not have one way of testing a question. Your examiner can actually test you in different ways, right? And that means you should be able to answer your question in a different way if it is tested differently, right? So I'm going to do the same calculation once again, right? The interest cost, which was 0.637. Remember, the interest cost was 0.637, right? So I'm going to do the 0.637 cost. I'll do alternative calculation, right? The answer will be still 0.637, but alternative calculation. Now, watch it very carefully. Rather than calculating 41.5 average receivable days, what do? I actually calculate the interest cost in two steps. I calculate the interest cost for those customers who will be paying us in 10 days, and I calculate the interest cost for those customers who will be paying us in 73 days. So I'll do two calculations now. Let's say interest cost number one, and then I'll do interest cost number two. I'll do the first one for those customers who are paying, who are taking the discount. And the second calculation, the customers not taking discount. I mean, it's the customer's choice, isn't it? If they want to pay early and get the discount, or if they want to pay late and don't take the discount. Okay, interest cost. It's not divided, right? I'm not dividing it, right? Right, I'm just explaining this. Okay, interest cost. Now again, the formula will be the same. Receivables multiplied by the interest rate, right? Receivables. How do you calculate receivables? Receivables is receivables is equal to sales multiplied by receivable days by 365, and then you multiply with the interest rate, right? That's what you do, right? So how much is sales? Sales is 40 million. How many are receivable days for the customers who are taking the discount? 10 days, right? Divided by 365. How many percent people are taking the discount, right? This will give you the receivables, but it's not for all the customers. It's only for the 50% of the customers. I'll multiply it with 50%. And then I'll multiply with the interest rate, which is 14%, right? In the same way, in the same way, I'll also say, let's say, for example, now those customers who are not taking the discount, sales is 40 million, but they'll pay us in 73 days divided by 365. And how many people, how many percentage of the customers are not taking the discount? Another 50%, the second 50% multiplied by 14%, which is the interest rate, right? So can you get me this figure and this figure and then calculate the total interest rate? Right? So those who are taking the discount, how much is it? 0.0767. Okay, what about this one? 0.56. Okay, if you add these two together, what do you get? 0.636. 0.636. If you round it, I think it will be giving you 0.637. 0.637. Now, can you see that? That's exactly the same figure. 0.637 was the interest cost. What did you do before? Average receivable days. And you did it in one step, but then you calculated average receivable days. If you don't want to do it, you can do it in two steps. Calculate the interest cost for those customers who are paying within the time period, 10 days, and those who are paying late and not taking the discount, right? So that will actually give you the interest cost in two steps. Now, why am I doing it in two steps, right? Look, your examiner can test it in any ways he wants. Let's say, for example, the examiner just asks you, let's say in a 2-marker question, to calculate the interest cost only relevant to the customers who are taking the discount. Then you just do the first calculation, right? So you should be actually comfortable with both the calculations. So please don't think that you have to master one method and then you are just going to focus on that method, right? You have to do it in different ways, right? Is there any question? Any question, guys? Okay, so that was 9.3, right? So what we have seen here, go back to the answer, we have seen here that not offering the discount, the overall cost will be 1.12 million, but when we offer the discount, we save some interest cost and our overall cost has reduced. So it means if we offer the discount, our cost will be reduced. Therefore, we should offer discount. Which discount? Early payment discount, or I'll say cash discount, right? The trade discount, yes, you can get the trade discount when you purchase in bulk, but trade discount will not be considered. You will only consider the cash discount, right? Okay, now 9.3. Let's do 9.4 now, right? We will consider that as well. Don't worry, right? It will be, we will practice on bad debts as well. We will consider bad debts also in some of the questions, right? But before we actually do 9.3, we said if we offer discount, well, of course, maybe we can save some cost. But you see, there is some problem with offering early payment discount, right? Early payment discount reducing the debtor balance, which means your receivables, and hence the interest charge. So that means the interest cost will be saved if we offer early payment discount, right? It may also reduce bad debts, right? Because if you're telling your customer, let's say, for example, instead of paying 70 days, you pay in 10 days. So let's say the customer has the money now and the customer can pay you within 10 days. But let's say after let's say 60 or 70 days, the customer will not have any money. So the customer may never pay you back. So you better get your money quickly from your customers. So it may reduce your bad debts. But the disadvantage is that difficulty in setting terms, like what should be the terms? Should we offer the discount if they pay us within 10 days? Should we say, well, 20 days, right? Should we say 30 days, right? What should be the terms of the discount, right? That will be a difficult decision to make. Greater uncertainty to when the cash will be received, right? You really don't know when the cash will be received. You see, we are just guessing that half of the customers are going to pay us in 10 days, but our guesses are never going to be 100% accurate. Let's say, for example, all the customers have taken the discount. So what will happen? You'll have a lot of cash. Let's say none of the customers has taken the discount. So you will really not sure, you will not be sure when will you receive the money. What will be the time of the cash inflow? Third point, may not reduce bad debts in practice. Well, in advantages, we said bad debts will be reduced. But practically, you see, if you have a bad customer who is actually buying from you with the intention that he's not going to pay you back, then offering him like a 1 day credit or 100 years credit is actually the same thing. Well, he's never going to pay you back, right? So maybe in practice, it will not be reduced. The bad debts may not be reduced, I said. And then the last one is very important, very interesting. It says customer may pay over the normal terms, but still take the discount, right? So let's say, for example, you have a customer, right? And you have offered him a discount that he can actually get a 2% discount. Now, another customer approaches you and say, why did you give him discount and not me? And maybe you can tell the customer, well, he paid us within 10 days, but I'm also your regular customer. How can you do this with me? You're offering discount to someone else, but not me, right? Are you going to make your customer upset? Maybe not. So maybe the customer will pay you in 73 days, but the customer will demand the discount as well. So this can also happen, right? Because you don't want to make the customer upset, right? Is it clear? Right? Now, the second option to reduce your receivable days was factoring. Factoring also reduce receivable days and therefore reduces receivable balance and therefore reduces interest cost. So factoring also can do this, right? The financing option, the factoring is giving you, we call it invoice discounting. The factor can give you the credit insurance, right? For which the factor is going to charge you something else. In case the debt is going bad, the factor is going to be suffering, not you, right? Let's say if you're business and you're getting the credit insurance, if the customer is not paying you back, the risk will be of the factor, not yours. And the factor can also give you debt collection service, right? So you will not need your own administration or credit control department. Maybe the factor can actually do it for you, right? Now all this will have some cost as well, and we have to see that the interest cost that has been reduced versus the cost that will be giving to the factor. Again, in the same way that we considered before, we will consider, are we saving more in interest cost or are we giving more to the factor? If we are saving more in interest cost and paying less to the factor, then we should take the factoring facility. If we are saving less interest cost but giving more to the factor, then we should not. Right? Clear? That's what we are going to do. Right? So let's see on the next question, 9.4. Question 9.4. It's again Shankly. So Shankly again. It's the same question, but again, it's the same question. So I'm going to write the facts relevant to the previous question, right? The fact was that our current interest cost is 1.12 million. Sales is 40 million, right? Current receivables, this is again the current sales. Well, the sales will be the same again, so I'll keep it sales. I'll call it sales. Current receivables are 8 million, right? So that's the current information that we have, right? But now we are not offering the early payment discount, right? This is relevant to question 9.2. Shankly again, but this time the factor has offered a debt collection service for which which should shorten the debtor collection period, which means receivable days, to 50 days. How many were the receivable days before? 73 days. Now, if we take the factoring facility, what will happen? Our receivable days will be reduced to 50 days rather than 73. If the receivable days will be reduced, what will happen? If the receivable days will be reduced, interest cost will be reduced, right? But now we have to consider that we have to give some charges. The factor charge is 1.6% of the sale. For what? For reducing, but should reduce the administration cost. Okay, there is another saving. Okay, good one. We will also get administration saving. If the factor will give us the service, maybe we will not need our own administration department, or we'll need less people in an administration department. So we'll get admin saving, number one. Number two, we'll get interest cost saving, right? But what are the charges? We have to pay 1.6% of the turnover, right? We have to pay 1.6% of the turnover. Did you notice one thing? Guys, the factor is not giving you the financing facility in this question. Can you see that? There is no interest charge to the customer. So no, there is no interest charge for financing. There is no interest charge. The factor is just giving you the debt collection service. The factor is just giving you the debt collection service. So in this particular question, there is no interest charge to the factor, right? If we will have it, we will consider that. But in this question, we don't have it. So question 9.4, right? So our current option, we said our overall cost was 1.12 million, right? If we go for the factors option, so how much will be our overall cost, right? So let's calculate it. The factor is giving you the debt collection service, number one, right? And the cost for the debt collection service, the factor is charging you 1.6% of sales. So sales is 40 million, 1.6% of sales. So how much will be the cost? 1.6%. Is it 0.64 million? Yeah, good one, right? Apart from that, our interest cost will be reduced as well. So how much will be the interest cost? Try to calculate the interest cost before me this time. Interest cost was receivable multiplied by the interest rate, right? Remember, the factor is not giving you our, the factor is not giving us in this particular question, the factor is not giving us the financing facility. So the interest rate will be still the order of interest rate because the factor is not giving you financing in this particular question. It is still 14%, right? How do you calculate receivables, right? It will be sales multiplied by the receivable days reduced to 50 divided by 365, right? So how much will be the interest cost? Anyone? Right? Is there anything else we should consider? Yes, there is one more, but this time it's not a cost. You have debt collection cost, interest cost, but then you have admin saving. If you take the factoring facility, you'll get admin savings, which was 175,000, if I'm not wrong. 175,000. Now, if it is 175,000 in millions, it will be 0.175, right? Now, if all the costs are without the bracket, then we can actually write the savings in the bracket. So how much will be our net cost? How much will be the total cost? This plus this minus this. Is it 1.23 million? 1.23 million or 1.232 million? Okay. Okay. So this is the cost. What do you think? Should we take the factoring facility or not? What do you think? Should we take the factoring facility? No, isn't it? The current cost is less than the cost that we're going to have with the factorings option. We should not take factors option as it will cost us more, right? It will cost us more. So in this question, the factor was just giving us the debt collection service. Remember, we said the factor can also give you the financing service, and the factor can give you the credit insurance as well, right? If the factor will give you financing service, then instead of the interest rate of the overdraft, you'll be writing the interest rate of the factor, right? The interest rate of the factor will be considered, right? Okay. But factoring option, in this question, we are just considering the cost, but there are some other factors which need to be considered as well. Like you see, the factor, even if it is cheaper, it can give, I mean, it can damage your reputation, right? Um, I mean, the customer may not like to deal with the factor directly, right? The factor, you may lose customers in the future. You may have like a bad impression in the market that, look, this company looks like to be suffering or have some liquidity issues. That's why they're taking the factoring facility, right? So yes, it can have some advantages and disadvantages, right? I'll actually give you a minute if you guys can actually read advantages and disadvantages, please, right? Can you quickly read advantages and disadvantages, please? Okay, yes, you want me to explain number four? Okay, anything else? Okay, let's see what is in number four. Disadvantage number four. It says once you start factoring, it is difficult to revert easily to internal control department. You see, like if you have taken the factoring facility, let's say now, right, you will start depending on the factor to collect your debt for you, right? And then you will never be able to have your own credit control department, right? Or you will never be able to promote your own credit control department or train your people. I mean, your people or your employees will never know how to collect the money from the customers, right? You'll start depending on them, right? So for a growing business, a small growing business, of course, is a good idea. But in long run, of course, you'll start depending too much on them. Maybe your own credit control department can be more efficient if they work for you in long run, right? Any other any other issue or anything? Okay, in your notes, there is like a typing error. It's actually part of a bigger question, but it's just here by mistake, so you can actually ignore it, right? So that was receivables management. And now we'll do a question on receivables management, right? We'll spend some time on this question, right? Let's open our question bank. Question number 39 from the question bank, Velmco, right? Now, this is a typical exam standard question on receivables, right? This is how normally your examiner likes to test it. Now, it's comparatively a very old question, right? The examiner used to test it in a different way before, and nowadays examiner tests it in a different way, right? So I'll actually give you the answer the way it is tested nowadays instead of the actual answer when it was tested before. If you want to see the actual answer, of course, I can give you the actual answer as well, right? Or the assumption on the basis of which it was calculated, right? We can discuss that as well. But yes, we will actually do the way your examiner likes to test it nowadays, right? Okay. Velmco sells stationery and office supplies on wholesale basis and has annual turnover of 4 million. So here's your sales, 4 million. The company employs 4 people in sales ledger credit control department at an annual salary of 12,000. So 4 people getting 12,000 will mean 48,000. So currently they are getting 48,000, right? All sales are on 40 days credit with no discount for early payment. I'm highlighting this for some reasons. Do you think it is receivable days? How many of you thinks this is receivable days? How many of you thinks this is receivable days? Well, this is not actually
Receivable days, sir.
receivable days. This is not the actual receivable days. You see, that's what we are offering to our customers, right? The receivable days is the actual time period the customers normally take to pay us back. So if we are offering like 40 days, and let's say if the customers are paying us in 50 days or 60 days, then the receivable days will not be the same, right? Okay. No discount for early payment. We are offering bad debts represent 3%. So bad debt represent 3% of the turnover. The turnover is 4 million. 3% of 4 million are our existing bad debts. Interest rate is 9% on our overdraft. Most recent accounts for the company offer the following financial information, right? So we're given the balance sheet. In the balance sheet, we have cash, receivables. Okay, so we can find the receivables figure from the balance sheet, right? Just in case if we need it, right? Um, we have the overdraft. Let's see what else do we have. Now, Valmco is considering offering a discount of 1% to customers paying within 14 days. If the customer pay within 14 days, we will offer them 1% discount, which it believes will reduce the bad debts also. Right now, this is new, right? As you said before, what will happen to the bad debts? Look, if you pay early payment discount, some of the customer who may not have paid you, but just because they have paid you early, that's why the bad debts are reduced as well. So bad debts will be reduced also because of the discount to 2.4%. Be very careful with the word to and by in the question. So whatever was it before, it will be reduced to this point. 2.4% of what? 2.4% of sales, turnover, 4 million, right? The company also expects that offering discount for early payment will reduce the average credit taken by the customer to 26 days. That's the average receivable days. You remember, we calculated that before in the previous question, but now we are given the average receivable days, so we don't have to worry about it. The consequent reduction in the time spent chasing the customer where the payments are overdue will allow one of member of the credit control department to take early retirement, right? Remember, we have 4 people working for us and we are paying each one of them 12,000. So that means our current cost is 48,000. Now, if one of them will get the early retirement because of the early payment discount, so our cost will be reduced to 36,000. 12 multiplied by 3 people now, right? So we'll be saving 12,000, right? 2/3 customers are expected to take the discount. Do you remember in the previous question we said 50% of the customers? So even like half, like normal average was also fine. But this time, 2/3 of the customers are paying, are expected to take advantage of the discount. So that means 1/3 of the customers will not take the discount. 2/3 are taking the discount, 1/3 are not taking the discount. In other words, we can say 66.67% of the customers will take the discount and 33.333% of the customer will not take the discount, right? Okay. Now, it's a 5-marker question and it says, using the information provided, determine whether a discount of early payment of 1% will lead to an increase in profitability, or in other words, we are saying, should we offer the discount or not? That's what we need to find, right? Now, you can actually do it in different ways, but let's do it the way we have done it before. So question, Welmco, part A. Should we offer the discount or not? What I'll do is I'll take the total cost if discount is not offered, right? Versus the total cost if discount is offered. So I'll do it here. Is offered, right? Okay. So what are the things to consider? Bad debts was 3% of the turnover before. Now it will be 2.4%. Previously, we had 4 people working for us. Now we'll have 3 people working for us. Previously, customers was expected to pay in 40 days, but we really don't know how much are they really going to take to pay us. But we don't have to calculate it for the current um, option because we are already given receivables in the balance sheet. So we don't have to calculate receivables, right? And now the receivables will be different as well. So the current cost, let's say, for example, the current option we'll have, first of all, interest cost. Interest cost, which is receivable multiplied by the interest rate. Receivables, which is as per the question, it is 550,000 multiplied by the interest rate. How much is the interest rate? 9%. So how much is interest cost? Anyone? How much is the interest cost? 49.5. Okay, let's do it together. So 550,000 multiplied by 9%, which will be 49,500. Right now, if you want, you can actually write it completely, or you can write it in thousands, or you can write it in millions. I'll write it completely. It's 49,500. Right? That's the interest cost. What other cost do we have? Bad debt cost, which is 3% of the turnover, and turnover is 4 million. So how much is the bad debt cost? 120,000, right? What about the salary cost? We currently have 4 people working for us getting 12,000. So that means currently we are paying them 48,000. So how much is our overall cost? 217,500, right? 217,500, right? So we will consider all the cost or the savings that are actually different in both the options, right? Anything that is different in both the options, we are going to consider it, right? So our overall cost currently, if we don't offer the discount, currently our cost is 217,500, right? What will be the cost if we offer the discount, right? First of all, the salary cost. Let's do the easy things first. Salary cost. Now we'll have 3 people working for us instead of 4. So our cost will be 36,000. One person will take early retirement, right? What about bad debt cost? Bad debt is going to be 2.4% of turnover. So 2.4% of turnover, 4 million, will give you 96,000, right? Good one. And now the interest cost. The interest cost will be Receivables multiply by the interest rate. We don't have the receivables figure now. The receivables figure is not going to be the same like the one in the balance sheet. Why? Because receivable days are changed, so receivable figures will be changed as well. So receivables, which is sales, 4 million, multiply by the average receivable days given to us in the question, 26 divided by 365. This will give us our receivables. If you calculate it, this is going to be less than 550,000. So 4 million multiply by 26 divided by 365. It's actually, it has increased. Something is wrong. Hold on. No, it's all right. It has reduced. You see, it was 550,000. Now it's 284,931. So receivables has reduced. Why? Because receivable days are reduced. What about the interest cost? 9%. So how much will be the interest cost? Can you find the interest cost for me? 25,643. Right? That's the interest cost. Is there anything missing? What is missing? We are offering early payment discounts. So what about the discount cost? And discount is 1% of 4 million. So sales multiply by 1%. But again, remember, not all the customers are taking the discount. Only 2/3 of the customers are taking the discount. So how much will be the discount cost? Can you tell me the discount cost? What is the discount cost? Anyone? Choose 6667. Right? So if you have all these costs, then how much will be our overall cost? So 184,310. Right? So if we offer the discount, our cost will be this much. And if we don't offer the discount, our cost will be this much. So cost has definitely reduced from 217,500 to 184,310, right? So should we offer the discount? Yes, right? We should offer discount as offering discount will save us how much? 217,500 minus this figure, which is 33,190. Right? So we should offer the discount as this will actually give us savings of 33,190. Right? Is it clear, everyone? Is there any issue? Now we're going to dissect this question. Right? No, it's not biology, of course. Right? I'm going to dissect this question. I'll actually do the same question in different ways. So don't say that it's a 5-mark question, so you just have to answer in a short way. So of course you have to, I mean, that's what you're going to do in exam, right? But I'm going to do it in different ways now so that you can actually solve the answer if the examiner actually tests it in different ways, right? So first of all, You see, we are given the average receivable days, right? What if the average receivable days are not given in this question, right? So I'm just making some notes. This is not part of the question, remember, right? Or we are actually solving this question in different ways. What if average receivable days of 26 is not given in this question, right? Now, if it is not given to us, then we can calculate it. How? First of all, step number one, find current receivable days. Remember, we are not given the current receivable days, right? We are not given the current receivable days. We said in here, it says that the customers, we are given a credit of 40 days. We didn't say that the customers are also paying us in 40 days. So we really don't know. Using this figure of receivables, we can find our current receivable days, right? So step number one, find your current receivable days, right? So that will be equal to receivables multiplied by 365 divided by sales, right? That's the receivables, right? Our current receivable as per the question is 550,000 into 365 divided by 4 million. So how much are our current receivable days? 50 days. It's not 40 days. It's not 50 days. The customers currently are paying us in 50 days, though we have offered them 40 days, but the customer currently are paying us in 50 days. Now I know that it's not exactly 50, but it will look very odd if you just write 50.1875 days, right? So it is 50 days, right? Now step number two, average receivable days. And we want to see, do we get 26 average receivable days if we calculated our own on our own, right? Now, two-thirds of the customers are taking the discount and they are going to pay us in how many days? In 14 days, which is about 66.67%, but I'll keep it in fraction. So the one-third of the customer will still pay us in 50 days now. So how much is the average receivable days? So it will be 2 by 3 into 14, which is 9.33, right? And 1 by 3 into 50, which is 1.66. Is it 1.66? 16.66 or 16.67. So if you add them together, you should get 25.99, or you can say 26 days. You see, even if it is not given, you can actually calculate it on your own, right? Okay. Now, this was the first thing. What if average receivable days is not given to us in the question? Now, the second question, right? Stop me if you don't understand anything. interest calculation in two steps, right? Remember, currently that we have calculated our interest cost calculation, we said we have used the average receivable days of people who are paying us in 26 days. So the average, on average, people are paying us on 26 days. But now we can see also that some customers are paying in 14 days and some customer interest cost calculation. And some customers are paying us in 50 days, right? So can we calculate the interest cost separately as we did it for question Shankly, right? So let's do it separately in two steps. Interest cost one, customers taking discount. And interest cost two, customers not taking discount, right? So how much was the interest cost currently? It was 25,643, and we want to see, are we going to get the same answer again or not? Are we going to get the same answer over here in total again or not? Right? So interest cost for those customers who are taking the discount, who will be paying us in 14 days, and those who are not taking the discount, they'll be still paying us in 50 days, right? So how do you calculate the interest cost? It's receivables multiplied by interest cost. So receivable multiplied by the interest cost, interest rate, right? That's what you do. Now receivables. Receivables is 4 million multiplied by receivable days, which is 14 days, divide by 365. But we know that those who are taking the discount are actually 2/3 of the customers. So multiply by 2/3, multiply by the interest rate, 14%. So what do you get in here? Try to do it before me if you think you can do it. Again, receivables, so which is sales, multiply by receivable days now will be 50, divided by 365. Now, 1/3 of the customers are not taking the discount and the interest cost is 14%. So how much is the interest cost for this? And then how much is the total interest cost? Oh, sorry. Yes, yes. Thanks for the correction. No, 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 no. Well, you see, the 550,000 receivables is our current receivables. It's the current receivables. But if you offer the discount, your receivables are going to be different, right? Your receivables are going to be different. So if you use this 4 million multiplied by 50 divided by 365, right? It will actually give you a similar answer, not exactly the same for some reasons, right? That I don't want to discuss now, right? For some reasons, it will be slightly different. But anyways, what do you get in total over here? What do you get in total in the first one? 14,320. Do you get this? 14,320, and the next one is 25,571. Do you all get this? 25,571. Do you all get 25,571? Yeah. Oh, so what will be the total? 28,693. 639. Is that what you get? 39,000? Okay, no. Yes, yes, let me correct that. 14,320 plus 25,571 would be 39,891. Nobody's correcting me. 14% was for the previous question. Isn't for this question, right? Nobody's actually pointing this out. The interest rate is 9%, guys. Come on. You should be looking at the question as well. Can you actually calculate it again, please? Interest rate is 9%. There's 4 million multiplied by 14 divided by 365 multiplied by 2 by 3 multiplied by 9%. The interest cost will be 9206. 9206. And the second one will be 4 million multiplied by 50 divided by 365 multiplied by 1 by 3 multiplied by 9%. This should be 16,438 or 9, 16,438. And with this, you add 9206. So it will be 25,644. 25,644, right? And what was the answer before? 25,643, right? So $1 is the difference because of the rounding, right? So the interest cost, we can actually do it in 2 steps as well. Let's say, for example, if you want to do it in 2 steps, yes, you can do it in this way, or you can calculate your average receivable days and then you can calculate it, right? Is it clear? Is it clear, everyone? Yeah? Is it clear? Okay. Now that's how I like to do it. The way examiners like it, I'm going to do it in the way examiners like it, right? Examiners style, right? Examiner actually like to do it using incremental cost and incremental revenue. Right? Examiner do it using the incremental cost and incremental revenue, right? So what does that mean? Can you see in all the calculations, right? Previous one as well, right? The previous question. I'm actually doing 2 questions. I'm actually doing 2 calculations. I'm doing the calculation if the discount is not offered, and then I'm doing the calculation if the discount is offered. And in the end, I actually calculate the difference, which is 33,190. Examiner actually just considers that what will be the benefit or savings or what will be the cost of having the discount option. So in the discount option, what will be the extra benefit or the extra cost? So that's what the examiner consider it, right? So for example, first of all, examiner will say savings on bad debt. Remember, bad debt was 3% before, and now with the discount offer, the bad debt will be reduced to 2.4. So what the examiner would like to do, right? Normally, that's what you're going to see in most of the answers, right? Both of them are perfectly fine. I mean, it's up to you. Sometimes examiner do it even in that way as well, right? Savings on bad debt. So 3% is the current bad debt, but it will be reduced by 2.4%. So the savings in the bad debt will be 3 minus 2.4, which means 0.6% savings in bad debt, right? So bad debt savings is 3% or 2.4% of sales, right? This is sales. So savings in the bad debt, how much will be the savings in the bad debt? Can you do this? Is it 24,000? 24,000? Yeah. So it's 0.6%, not 3 points on these 0.6. You have to consider the percentage as well. That's 0.6% of 4 million, right? It's 24,000. That's the saving. And that's what we can do in our own calculation, the previous calculation as well. You see, how much is the bad debt after the discount option? 96,000. How much is the discount? How much is the bad debt before this option? 120,000. 120,000 minus 96,000, what do you get? 120 minus 196,000. This will also give you 24,000, right? So 120,000 minus 96,000 will also give you 24,000. Next one, savings in salary cost. We had 4 people working for us before. Now we have 3 employees working for us. So we'll have only one extra employee. 4 minus 3 will be 1 employee. And for that 1 employee, we'll be saving the salary of 12,000. So it means we'll be saving 12,000, right? So savings in the salary cost is 12,000. How much was it before? 48,000. How much is the salary cost after? 36,000. 48 minus 36 is also 12,000, right? Clear? Yeah. And then the discount cost. Well, of course, there wasn't any discount cost before. So the discount cost calculation will be only now. So it will be exactly the same. 4 million multiplied by, I guess it was 1% discount if I'm not wrong. Yes. And only 2/3 of the employees were taking the discount. So how much is the discount cost? Is 2,667. There wasn't discount cost before, and it's only after. That's why we are just considering the discount cost, right? Any other cost? Yes. The interest cost. The interest cost is the calculation that we are going to do now, right? You have to be careful with this one, right? Interest cost, you actually calculate, I'll do it in red, right? If you want, you can do it separately in the working, or if you want to do it within the answer, you can do it, right? So it will be, instead of receivable multiplied by in the interest rate, you'll say reduction in receivables multiplied by the interest rate, right? Reduction in the receivables. Reduction in the receivables. So how do you calculate reduction in the receivables? Receivable before minus receivable now is the reduction in the receivable multiplied by the interest rate, right? Now from the balance sheet, we know that the current receivables before receivables are 550,000 is given to us, right? Minus the receivables now, we're going to calculate it. I'm going to put 2 brackets. Receivables now, which is sales multiplied by receivable days divided by, multiplied by the receivable days, which is the average receivable days, 26, divided by 365, right? and then you multiply it with 9%, right? Can you actually give me the reduction in the receivable first? The reduction in the receivables. Can you actually give me an answer for this? 4 million into 26 divided by 365. So it's 284,931 and before was 550,000. So receivables has reduced by this much. So the interest cost will be also reduced by this much. So 26, 5068, 26, okay, 265069, 265069 multiply by 9% will be 23,856. Now look, 23,856. That's the interest cost. But that's not the interest cost as well, because receivable has reduced. So interest cost will be reduced by this much. So we'll say this is interest cost savings. The interest cost will be reduced by this much. So we have a discount cost and the rest are savings. Savings on bad debt, savings on salary cost, discount is cost, so it is negative. And then you have interest savings, right? Interest savings. Now, right? The discount is the cost and the rest are savings. Now, we have calculated this figure. Let's see what was this figure before, interest cost savings, right? Now, we had interest cost of 49,500 and the interest cost later on after the discount option was 25,643. So 25,643. So the savings in the interest will be 23,587. And that's what we have calculated here, 23,587 or 6, right? It's just because of the rounding. Can you see it? So how much is our overall saving? How much is the savings? 33,189. 33,189, right? And that's what we calculated before as well. You see here, 33,189 or 190, right? Is just a $1 difference, right? Now, is there anyone who has any confusion? Please do let me know. Anyone with any confusion? So we have actually done this question in different ways. I want you guys to do it in different ways. Don't just stick to one method. If you just dissect it like this, it's like you have done like 2 or 3 questions rather than just doing one question, right? Because examiner tests it in different ways, right? Examiner tests it in different ways, so you learn it in different ways, right? So in your first question, of course, you should be learning it in different ways. Okay, now part B of the question, discuss relative merits of short-term and long-term sources of finance. You remember, I told you that's how they test it, right? What's the benefits of short-term finance and what is the benefit of long-term finance, right? For 6 marks, so much easy 6 marks. You simply have to see it from your notes. If you remember in your previous lecture, we discussed it, benefits of short-term finance and benefits of long-term finance. So that's your homework. Please share it in the group after the class. Then it says part C, discuss different policies that may be adopted by a company towards financing of working capital needs and indicate which policy has been adopted by Velmco, right? What are the working capital financing policies? Come on, who's going to tell me the working capital financing policies? Aggressive, Conservative and moderate policy. Aggressive, conservative, and moderate policy, right? Now, for a 7 marker question, now again, that is your homework, but I'll help you with this. Discuss different policies that may be adopted by a company towards financing working capital, right? You have to discuss 3 policies, and then you have to say that which policy is followed by Velmco, right? Now, that's a challenge. So, how do you find the calculation? I mean, so part C. Was it part C? Yes. So part C, you're going to start with headlines like aggressive policy, right? Aggressive policy, if you remember that most of the current asset, including some of the permanent current asset, is financed by short-term finance, right? Conservative policy, another headline. So you have to say that most of the current asset, including some of the permanent current asset also, is financed, or I mean, all the fluctuating current asset, including most of the, I mean, all the current asset, including, sorry, let me say it again. Most of the current asset, including the permanent current asset, also by long-term finance. And instead of matching policy, I think a better word would be moderate policy. So aggressive policy, we said, mostly short term, even for most permanent current asset. Conservative, mostly long term, even for most of the fluctuating current asset, right? And moderate policy, right? Somewhere in between these two, right? Somewhere in between these two, right? So, but now which policy is followed by Valmco? That's the question, right? So let's open the balance sheet and let's see what can we see in the balance sheet. So watch it very carefully. Watch it very carefully, right? Watch it very carefully. We can see here that our total assets are here and the total equity and liabilities are here, right? So that's the sources of finance, and this is where we use our money, right? Now, if you subdivide it, first of all, can you see the non-current asset? What is the logical approach to finance our non-current asset? We will say the non-current asset mostly is going to be financed by long-term finance. So where is the long-term finance? We have ordinary share reserves. So here is the equity finance and here is the debt finance, right? If you add these two together, what do you get? 15,140 plus 2,400. What do you get? 17,540. Now, how much finance, how much long-term finance do we have? 17,540. And out of 17,540, 17,500 is used for non-current asset, right? So the remaining 40, don't you think that it will be used for current assets, right? It will be used for current asset. Don't jump to the conclusion. Hold on a second. Hold on a second. Right? So we can say that 17,500 out of 540, 500 out of divided by 17,540 is finance. So 99.77% of the non-current asset with finance with long-term finance, right? So the remaining 0.99%, only less than 1%, right? The long-term finance is used for the current assets. So only 1% is used for current asset long-term finance, right? So what does that mean? That means that if you consider short-term finance now, which is trade payables and overdraft, that's the short-term finance. And where are the current assets? Well, current assets are here. The current assets are here, 1570. So if you add them together, that will give you 1200 plus 330, which is 1530. 1530 is the short-term finance and 1570 is the investment in current asset, right? You know, the finance is short by $40. So from where do you get that $40? Here. So what does that mean, right? If you want to see the short-term finance, for example, you can see here 1530 out of 1570. Sorry, 1530 divided by 1570, which is 97% of the finance, of the short-term finance is used by 97% of the short-term finance is used to finance your current asset. And only 2.5% of the short-term finance is used for by non-current asset, right? Does this make sense, guys? Right? We'll write it down. We'll write it down and then we'll discuss it. So Wellco's policy. Right? Short-term finance, long-term finance, current assets, non-current assets, right? We know that the short-term finance is, if you add these two together, 1200 plus 330, it is 1530. Short-term finance, 1200 plus 330, it is 1530. Long-term finance is 17,540. Current asset is 1570 and non-current asset is 17,500, right? I'm simply picking up the figure from the balance sheet, right? You don't have to write it down, but look. Number one, we can say 1530 out of 1570, which gives you 97.45. 97.45% of short-term finance is used to finance current asset, right? So the remaining is about 2.5%. So you can say, so out of 1570, 1530 is short term. So the remaining 40 out of 1570 is the long-term finance. So 2.5% or 2.54%. 2.5% of finance is by long term. To 97.45% of short-term finance is used to finance current asset, and 2.5% of finance is financed by long-term finance. So what do you think? It's aggressive policy, right? Most of the finance is short-term. Most of the finance is short-term. Now you can see that, well, over there we were also discussing the permanent current asset or the fluctuating current asset. Well, of course, we cannot see the permanent or the fluctuating current asset in the balance sheet here, but we can clearly see that most of the finance is financed by short term and just a very small amount is actually used by long term. Now you don't have to write that how is the non-current asset finance, because this question is about working capital, right? This question is about financing working capital, so this is aggressive policy, right? Aggressive policy. Is it clear, everyone? Is it clear? So yes, that's aggressive policy. As we said before, aggressive policy is more profitable, but it's a very risky policy, right? Yes. So that's how you do. Let's say, for example, if you have to do like calculation for this, so of course you can do it. Now, the last part of the question is again your homework. It says outline advantages to the company of taking steps to improve working capital management, giving examples of the steps that can be taken, right? Now, in your notes, do you remember the day-to-day management, right? The day-to-day management, like for example, what can be the steps that you can take? You can send like reminding letters, or you can just call them, or for example, you can give them a threat of taking legal action, right? Those are the steps that you can actually take. But you also have to give advantages to the company of taking improving the working capital management. What will you get if the working capital management is improved? You'll have less bad debts, you can save some interest cost, right? You can do the credit worthiness of the customer, so you would know that which customer is good and which customer is bad. You can categorize your customers in different categories, right? So again, like it's quite a journal question, quite a journal question for 7 marks. Like it's very generous, isn't it? Very generous. So that's how you actually answer a question on receivables. Is it clear, everyone? Yes, thanks for identifying that this is not just for receivables. I mean, there are other things also, like the steps that you can do for inventory or cash management. But of course, you have not seen inventory management or cash management. So we just discussed the steps to improve um, the receivables, right? So yes, it should be for the others as well, right? Okay, now just for those students who are actually interested, right? You guys can wait for 5 more minutes, right? So I'm going to tell you something. The way it was actually tested before, right? And the way it is actually tested now, that's how you do it nowadays, right? The way we have done it today, that's how you do it nowadays. But just in case if you're interested, what the examiner used to do before, right? Do you remember the difference between trade discount and cash discount? So I'm not worried even if you don't understand this point. But the cash discount was for early payment. And the trade discount you get on the spot. So for example, if I'm selling a mobile phone, let's say for example, and I'm selling for $500, and let's say you're telling me, okay, how about $450? So I said, okay, I'll give you this discount. You can buy it on $450. This is trade discount, right? With bargaining, let's say, or with bulk purchase or anything, right? I give you this discount on the spot. Cash discount is early payment discount. Now, why is it important? Because trade discount, we will definitely know that how much is the discount. In early payment discount, we will not be sure if the customer will take the discount or not, right? That's why their treatment is going to be different as well, right? The early payment discount will not be recorded as full sales, and the trade discount will be recorded as full sales. So let's say, for example, if I'm selling it at $450, so I'll be recording $450. In cash discount, we really don't know if the customer will be taking the discount or not. So we are going to record it at 500. And let's say if the customer takes the discount, then we'll adjust the $50 later on, right? So on that basis, we will treat it differently, right? But currently the subject that we are studying is not for recording purpose, right? We are not just doing the recordings, the financial recordings, right? We are actually guessing our cost for the future, right? So we said, look, should the sale be, the question is, should the sale be considered 4 million, or should we deduct the discount from it? Should we consider the sales to be 4 million, or should we consider the sales to be 4 million minus 2,667, right? Now you might be thinking that, well, it is early payment discount. It is early payment discount. So we should not consider, it's early payment discount. So we should consider sales 4 million rather than the discounted amount deducted, right? Because it's cash discount, right? So we'll keep it we'll keep it separately. But look, examiner, what he used to do before, he said, okay, it doesn't matter if it is trade discount or cash discount, right? Doesn't matter if it is trade discount, like if you're selling it for $450, right? Or let's say you consider it 500 and later on you deduct 50 and then consider 450. In both the situation, we are saying that it's going to be 450. So we should actually deduct the discount from it, and the sale should be considered 450,000, right? That's what the examiner used to do about 10 years ago, right? In most of the questions. Nowadays, what the examiner do, he thinks that, well, it's trade discount and it's different from cash discount, right? The trade discount is actually different from the cash discount, right? Right? So you should be, okay, hold on a second. Okay, what did I say before? Hold on. Okay, let me say it again, right? Yes, trade discount will not be considered, of course. Trade discount will not be considered in your question, right? But previously, the way examiner used to do it before was like this, right? He was considering 450, considering that the discount amount need to be deducted from sale. Nowadays, the sale will be considered 500,000, right? Nowadays, examiner is going to consider the full sale amount. So the way examiner did it before, right, or he used to do it before, right? Like for example, if the sales are given to you over here, where is the sale figure gone? Here, right? So the sale figure that examiner used to write before, 4 million, instead of this, examiner used to do it like this, 4 million, but he said, well, doesn't matter if it is cash discount or trade discount, you deduct the discount amount from it. So 2,667. So now this will be the sale figures that you'll be writing here. And now this sale figure multiply by 26 divided by 365 multiply by 9%. So that's what the interest that you should be recording, right? Now we have done it in this way. Examiner may record it in some questions in this way or some questions in this way. It's just on the basis of different assumption. So it doesn't matter which answer you get, this answer or this answer. Both of them will be considered correct. Both of them will be considered correct, right? So if you actually got what I'm saying, and I'm very happy for this, but if you think you didn't get it, it doesn't matter. You just do it the way I have done it in the class, right? And in the most recent exam papers, you are going to see the questions like this, the way we have done it above. All right. So if you consider the cash discount to be different than trade discount, and you think that, well, accounting treatment will be different, so I should consider this. That's one assumption. The other assumption will be like, well, doesn't matter if it is cash discount or trade discount. It is important for the people who are actually doing record keeping, the reporting guys, right? We are just doing financial management, and we are actually interested in the end figure, right? So you can consider this as well, right? It's up to you. It's up to you what you consider, right? Okay, this will be enough for today. Question one go, right? Make sure you actually do it a couple of times, right? And tomorrow we'll do some practice question on receivables. All right. If you have any question, please do let me know. Otherwise, I'll see you in the next class.